Hello dear traders, welcome. This is a very important presentation and somebody requested that I should elaborate on this topic, namely how to use stops in your trading, what are the implications, how does this work also with the market causality, etc. So this will be a presentation where I will discuss all the basic aspects of that particular topic. I may do another one at a later stage, which would be about more advanced topics in the space of risk management, using stops, protecting your trades, etc. And I really try to keep this presentation as simple as possible, as accessible as possible. So this is the first point. If no stops are used, one single trade can destroy your account. Let this sink in, please, okay? One single trade, if it's not protected by a stop, can completely blow up your account. Now, no matter what somebody says, no matter what all these trading coaches try to explain to you, etc., this is a fact. Of course, there are other ways to protect yourself, like hedging, and we come to that. But this is a universal truth, okay? All it needs to destroy your trading account is a single trade, which goes in the wrong direction, which is a certainty. It will happen, no matter how good your strategy is. Eventually, one trade will go completely the other way. And if you do not get stopped out, often this results in a very, very big loss, which destroys your account and your performance, okay? Now, some people will answer to that, well, but I have a risk management where this is taken into account. Yeah, there are some advanced ways to think about your risk management in terms of, okay, if something goes wrong, I will lose this account, so I just have a number of smaller accounts, but this is more advanced. For now, just understand that this here is a reality, okay? You do not want to just place trades in the FOREX markets without having your protection in place, okay? Without a stop, even if you monitor it, eventually one of the positions will completely go the other way and you will be done. Do not do that, okay? There are some exceptions, I will come to that, but most people who watch this, okay, who trade small or medium accounts, you can't afford to not use protection, alright? If you do not understand that point, you will find out yourself the hard way what I mean. Now, obviously, if you use stops and your stops are too tight, you will get stopped out all the time, basically. Yeah, you will get whipsawed. No question about it. Okay, if you put your stop 15, 20 pips away, most of the time you will get stopped out. Okay? So that doesn't work neither. You will just slowly bleed out. So another point is, even if you use stops, and even if the stops are rather far away from the current price, or there's enough room for the price to move around, obviously the balance between your risk return is important. If you have stops which are far away and then once you get stopped out, this is equivalent to 4 or 5 winners, that's not a good deal, obviously. Yeah? And of course, without the market causality and all the tools, it's very, very difficult to use stops efficiently. No question about it. You need to understand where are the stops of the dumb money, where are the position nests, and I will show you some examples in a second. And then you understand where you can place your own stop, you know, without just getting randomly stopped out. Now, there are some exceptions to that statement I made. For example, if you trade a very, very big account, such as above $100 million, and in my career I was once in a position where I did that, believe it or not, the game is different. You can't really use stops for certain reasons, which I will not elaborate on here. Obviously, you need risk management in place, no question about it. But when it comes to those particular details, it's actually more complex than when you trade a small or medium account, all right? So that's one exception. Now, some traders will have equity stop rules, so they may not place stops directly for each trade they place in the market. However, once their open trades reach a certain amount of drawdown, they will close all the trades at this loss no matter what. And obviously that loss will be proportionally high to the average winners. Okay, this is a possible path, but you need to be really, really good at that. Remember, once I did the podcast with Zoltan, he has equity stops. So that means if a certain loss is hit, like I think in his case around 10%, he will just close everything and work his way slowly up again. Very difficult to do. Most people are not able to do that. Of course, there is other alternatives. You could use hedging. You could place, let's say you buy euro dollar, you could place a sell stop below the price. So when the price goes against you, you at some point freeze the position. But again, you need to be able to work your way out of that position later. It's just freezing the current loss. Again, the market causality helps you a lot with this, but it's not as simple as it sounds. Hedging can be very demanding. And there are other exceptions, such as market making companies. They may have positions because they earn the spreads, but they do not necessarily use stops on each trade. So let's go through what I explained before. Like here, if your stop is too tight, you will get stopped out. Even like here in this example, you were right and the price went up, it kicked you out beforehand. So that if the stop is too tight, that does not work. And if you don't believe that, you can test and back test strategies and just place a tight stop. That's, by the way, an exercise I could do in another video. Like run a few tick data back tests in front of your eyes where you see these things also. Now, the other example, if your stop is too far away, yeah, like an emergency stop, this is very bad, because if your stop gets hit, the loss resulting from that is like 8 times higher than the profit you made. Not a good strategy, okay? Especially since you do not know the sequence of winners and losers. Maybe you have 2-3 stop loss hits in a row, and then guess what? 3 times 8, you have times like the 24 winners destroyed, okay, in a sequence of 3 losing trades. So if your stop loss is unbalanced, like here, it will be a losing strategy. Even if you have a high win-loss ratio, you may pick up some pennies, but eventually you get the big losses. Doesn't make sense. What makes sense is to have a balanced stop loss and take profit. And in the best case, to have a good risk-return ratio. So if your profit is 2 times, 3 times higher than your stop loss, even better. Now, as we know, on the lower time frames, it's sometimes difficult to have trades with a very good risk return. But the minimum should be some balance, okay? If you trade on a 30-minute time frame, even on the 1-hour time frame, if you have a certain target, let's say it's an MTS, a medium-term stop, your stop loss shouldn't be significantly further away than your target. You need to have your trades in balance, so that if you win or you get stopped out, it never has a disproportionate impact on your overall P&L performance. You understand? So, the reality is, of course, like many people think or try to convince themselves they have winning systems, but once they add stops to your strategy, this is what the performance looks like, yeah? And the ones of you who have conducted a lot of backtesting, like myself, you know exactly what I mean. Like most strategies, as soon as you add stops, they do not have any profitability whatsoever. But think about it. What's happening here is the reality is coming out, because once you add that necessary factor of a stop, of protection, you see the truth that the system is not profitable at all. Okay? But do not try to cheat yourself by not using stops, okay, and then thinking, no, eventually everything turns around. What goes up must come down. Wrong. If you're on the wrong side of the squeeze, it will take you hundreds and thousands of pips in one direction and will blow you. Do not do that, ladies and gentlemen. And please understand also that principle. Like, look at those sailors here. They have the life vest on them. Now, if they wouldn't wear it, most likely they would be faster because there's less weight on the ship. But what happens if there's an accident and somebody loses consciousness and is in the water and doesn't have the vest on? Okay, he or she could sink down and die. So that would be the catastrophic scenario, equivalent to an account blow up. You need the protection. It's a self-imposed rule, if you will, because there's no legal obligation to use the stop. The broker is more than happy to let you trade without stops. But you need to respect the rules of the game. In Forex, you have to have some protection in place. You can't trade without protection. If anyone tries to convince you, then be careful. This is not good advice. So let's come to the question somebody asked. So where should I place my stop? And this enables me to give you some cool examples, right? So we, as causality traders, we see where the money positions are. We see where the stops are. So like here, of course, let's say you want to sell for some reason. This is not trade, but obviously you want to place your own stop above all these short-term stops of the money and also above all the long positions of the money here. Because in order for the price to really stop you out, that means that, you know, all these stops would need to be taken out, and then the price needs to overshoot also. Most of the time the price will take the stops and then turn down again. So this is your protection, to place your own stop above the other stops if you are selling. And in the other scenario, let's say you're buying for some reason, the same holds. Like here, look, we have an order gap zone, we have some short-term stops, we have all those down money seller nests here. Of course, we place our own stop below that potential support, okay, if we're buying. Let's say we buy to the upside, then of course if the price goes against us, there's a chance that if it takes these stops, it will turn right after, okay? Or there's a chance if it kisses this position nest here of the down money shorties, it will turn right after. So that's something we need in our favor. And again, remember, there needs to be balance between your target and your stop loss. So here another example. Look, if we would buy towards the upper MTS, we place our stop below the short-term stop, below those shorties, okay? Below those lows, right? If we would for some reason sell this market, we place our stop above the short-term stop, the MTS, the order gap zone with the spread, okay? And above those longy positions, above this plateau. It's common sense, isn't it? So that if the price goes against you, there's a lot of chance for the price to still turn in the right direction, which often happens, as you know. Yes? Now, if you have a very significant dumb money nest on your chart, like here recently we had an Australian dollar here on the forward chart, of course you place a stop and you trade this move. Of course you place your own stop below that dumb money nest, because even if the price goes down, it will kiss it and then go right up after, right? So pay attention to the y-axis. Now when it comes to 4-hour reversals, let's say you trade a 4-hour reversal on the higher time frame, that's a bit easier. Of course you just place your stop far away enough from the lows and the lower band if you buy, and above the highs and the upper band if you sell. Yeah, you do not want to get kicked out with a retest when the 4-hour reversal is fully valid and will come right after. So there you need to give the price a bit more room to move. But again, look, when you place the stop here, you need to have a target around here to have some balance. In this case, it went all the way to the other 4-hour reversal band, which we often see. So it was even a good risk return, but it's also on the higher time frames, yes? So that's essential. Now and then you may get fished out, fine. Okay, maybe you place your stop a little too close or whatever, or, you know, the dumb money came in again, fine. But then you can reevaluate. Do I place the trade again because it's still valid? All right, or do I wait a little bit to get even better prices, etc.? All right, you can't avoid getting stopped out now and then. It's part of the game. Now there are other situations which are more complex, like sometimes, let's say for some reason you want to sell this market, which was dollar yen, against the longies. If you can, you will of course place your own stop above the first LTS, yeah, that even if there's a crazy move, you do not get kicked out. However, if you do that, you also have to try to ride to the lower band in this scenario to have a roughly balanced risk return, okay? Every system, every approach has win-loss ratio, risk return, trade frequency, risk per trade. These are the parameters of any trading system, and there needs to be some balance regarding risk return. Now, of course, this leads us to a whole other list of topics I can elaborate on in the future, such as risk per trade. Okay, how much do you risk of your account per trade? Often this value lies around 1.5% for the best trades, and then you decrease it according to all the minus factors on your checklist, okay? And we as causality traders distinguish between a low bias, medium bias, high bias. This is for the best. For a low bias trade, we may only risk, for example, 0.2% on the trade, okay? so that we get stopped out, we don't lose much relatively to all the other trades. Okay, there needs to be balance again. Now, of course, we also would need to talk about trade management. Yeah, let's say, what about moving your stop to break even, or trailing a trade, or trying to ride it even longer, and scaling in, scaling out. These are all relevant aspects I should elaborate on in other videos. And then, of course, it's more complex. Yeah, what's your trade frequency? Are you a intraday trader, day trader, swing trader? You trade the lower time frames, the higher time frames. So these are all considerations, because the more trades you do and the more times you're risking that 1% per trade, for example, this implies, of course, more risk you're taking overall. Yes. But anyways, I hope you like this very, very short, concise presentation. Okay, go to the website, use it, and please remember, we are not gamblers. Yes, we do not assume that every single trade will work out or the price comes instantly. Do not trade without stops. And the worst thing you can do, the blow up strategy, is no stops plus over leverage trading plus a very low selection of trades, like a bad selection of trades. That will always lead to a complete blow up. Do not do that. Treat trading as a business. Be professional. Have your rules in place and follow them. Okay? Then everything is fun. If you get kicked out now and then, try to learn why that happened and accept that we can't win every single trade. All you need to do is to win most trades. All the best.